Namaste investors, welcome back to the channel. Today we are clearing one of the biggest confusion in the stock market analysis, that is ROCE versus ROE. What are they? How are they different with each other, and which one should you trust more while analyzing a company? And most importantly, which metric works best for which type of business? Let's keep it simple, practical and extremely useful. Let's begin to understand. Now the first thing is, what is ROE? Okay, so ROE means return on equity. It tells you how efficiently the company is using shareholders' money to generate the profit. The formula to calculate is ROE is equal to net profit of a company divided by shareholders' equity. Simple explanation if I have to give you, if you give a company 100 rupees as your equity, ROE tells you how much profit that company generates using that 100 rupees. Why ROE matters? The first thing, it shows how the management is it shows how good the management is at using the shareholders money, using the funds, how they are efficient. It helps compare companies in the same sector. It helps you to comparison with peers. And the third point is, high ROE is equal to efficient business model. But ROE has a problem. It can be manipulated using the debt. See, if a company takes a lot of loans, its equity becomes small and ROE artificially looks high. So ROE alone can fool you. Now, the second section of our video is, what is ROCE? So this is basically return on capital employed. This tells you how efficiently the company uses all the capital, both equity and debt. Its formula is to calculate earning before interest and tax divided by equity plus debt. Simple explanation is, if a company uses your money plus the bank's money, the loan which they have taken, the ROCE, return on capital employed, measures how well it is using the total capital invested. Now, why ROCE matters? First, it shows the true operational efficiency. It shows true operational efficiency. Second, it cannot be manipulated. It cannot be manipulated easily by taking more loans. Third, it is best for comparing capital heavy industries. And the last point is, it gives you the more realistic picture. It gives you more realistic picture of profitability. Now the main point of our video, ROCE versus ROE. So there are two key difference. Basically, the first is capital considered. In ROE, only equity is taken into consider, and in ROCE, equity plus debt it's considered. Second, manipulation risk. In ROE, it can look high due to high leverage. In ROCE, it is more reliable. Third point is industry suitability. ROE is suitable for the companies which are best for asset light businesses, like if we have to go to FMCG, like IT services. And ROCE is best for capital heavy businesses like manufacturing, power, metals, telecom, and various businesses which have a very capital heavy businesses. Fourth point, the difference is profit metric. ROE, it uses net profit after tax, and ROCE uses EBIT. That is profit before interest and tax, removing debt distortion also. Distortion also. So that's last difference what I think, investor viewpoint. ROE is a shareholders return, and ROCE is business operational efficiency. Now let's take some real world examples. Example one, like if I have to quote Asian Paint. Lately I'm studying a lot about Asian Paint's business, so I can easily give an example. It has a very low debt currently. They have very high margins, and ROE and ROC both remain consistently strong, that is about 20% plus. So this shows strong business fundamentals and efficient capital usage. Second example, we have like Tata Steel or Power. You can consider again high debt. They have very high debt due to capex. ROE looks average, and ROCE gives a better picture. Here ROCE in Tata Steel is must check metric to understand real performance. So now the question arises, the main, which metric should you use? If the business is asset light, that is IT or FMCG or for sake pharma and services, check ROE first and use ROCE for extra confirmation. You should always go for first, should give preference to ROE in these industries, and then you can go for ROCE for extra confirmation. If the business is asset heavy, that is power, metals, manufacturing, telecom, in this case first you can check ROCE, and in this scenario don't rely on the return on equity. In general, the rule is For efficient low debt companies, ROE is the best, and for heavy capex or leverage companies, ROCE is the best combination. So what is good? Basically, ROE is good or ROCE is good. See, good ROE means return on equity for any company 15% or more is the sustained. If it is sustained over the years, that is good. Good ROCE, anything range to 12 to 15% for heavy industries, and 20% or more for high quality compounders. But remember, always check 5-year consistency, not just 1-year number. Conclusion, let's close this video. So now you know the exact difference between the ROE and ROCE, when to use which and why. Both are extremely powerful matrices for analyzing the business. If you found this explanation valuable, hit the like button, subscribe to the channel, comment below which ratio you want me to cover next: ROA, ROIC, or debt to equity, anything. So thanks for watching. I'm really sorry. I'm really sorry for my voice. Thanks for watching. Love you all. God bless us. I'll see you in some other video. Bye bye. Take care.